Okay, hi and welcome to FTSE Funds and Finance, episode 2. I'm joined again by Steve Goodwin and Josh Goodwin, both financial advisors at Goodwin Financial Services. We're going to talk today about interest-only mortgages, its history, the benefits of it. Just a caveat here, obviously what we're talking about here, we're not saying interest-only are for everybody. Obviously that's why you have an advisor and someone to talk to. This isn't constitute as advice, but we just wanted to talk about interest-only mortgages as they've had a bit of a resurgency recently. So Steve, talk about interest-only. Most people have heard of interest-only mortgages. People will probably shriek at the thought of them now because obviously they've got a bit of a bad rap in recent times. Where did the interest-only come from? What's the history of interest-only mortgages?
Back in the 80s, the early 80s, when I talk about financial advisors, nobody was qualified. In the mid-80s, it was the Wild West. Anybody could go out, believe it or not, and advise on finance with no qualifications. They could be a window cleaner 1 minute and a mortgage broker, financial advisor the next minute. It was the Wild West. And back in those days, the big thing was what's called endowment mortgages, because people that were selling this stuff were making fortunes, and I mean fortunes on commissions of selling these plans that were flawed, massively flawed. But they were sold. Fortunately, we never got involved in it because it was something that generally we avoided doing. But at the time, people would have an interest-only mortgage and then have an endowment policy in place to hopefully pay the mortgage back 20, 25 years later. What happened though, a lot of these plans didn't pay the mortgage off 20, 25 years later. So history showed that there was a problem. And then people sued to get their money back, and it was a bit of a disaster. But there was nothing really wrong with the interest-only concept. It was what was going along with it and what people were selling as a product alongside it. That was the problem. So interest-only, really, people shied away from doing it. Lenders really pulled away from it. Repayment mortgage became the thing. I mean, for me, personally, I've only used interest-only mortgages myself my whole life. It's been the only way that I've repaid debt. But for some people, it works. For some people, it's like the worst thing you can ever do for them. So you have to gauge who your client is. But they've got a very, very important part to play. And to give you a very basic example, let's assume somebody wants to buy a house today and they buy something for $250,000 because the mortgage payment on a $250,000 house is all they can afford on a repayment basis. Now they may, for the same amount of monthly payment, be able to buy a house for $450,000. Now, houses tend historically to double in value every 15 years. So if you imagine that the $250,000 house in 30 years' time will be worth $1 million, but the $450,000 house will be worth $1.8 million. For the same payment, somebody has lived in a much bigger house and a better house. And at the end of 30 years, they've got their house is worth £800,000 more. Yes, they've got a mortgage, but they could then potentially sell that 1.8 million house, downsize to the 1 million house they'd bought in the first place, and they can bank the difference in money. Mm-hmm. So there is a very important concept with that. And also by having interest only, you have the idea that your payments are lower than they would be, and you can therefore do other stuff with your money and create more wealth. Mm-hmm. So for some people it is fantastic. The negative of interest only is somebody that may buy a 1-bedroom flat or a 2-bedroom flat, buy interest only, live the high life for the next 25 years, get to the end of 25 years, still have a mortgage and have no means of paying it back, mm-hmm. and be evicted. So interest only is not for all, mm-hmm. but it can be used very smartly for people that understand what they're doing and why they're doing it and how they can create wealth. So that's really the summarization. But it's becoming more popular now.
Yeah.
As interest rates rise, and there are more financially astute people out there that understand them, mm-hmm. And therefore it's becoming something that I think Josh will say it's becoming much more prevalent in cases that we handle.
So if people are maybe the first time have heard of interest-only mortgages, so in essence an interest-only mortgage, you only pay the interest on the debt. So you got a mortgage £250,000 and you pay that for the next 25 years. you're only paying the interest on that. At the end of that 25 years, the £250,000 is still owed.
Stays flat
You've got
the
a thing.
mortgage term.
So again, as you talked about the endowment policy beforehand, there's generally a repayment vehicle that you run alongside the interest only, or you can do potentially. Is
Yeah, so where's a standard repayment mortgage? Most lenders' criteria, although different, generally all ask the same things in terms of credit rating, blah blah blah. When it goes to the interest-only side of lenders, they're all completely different. Not everyone will fit one lender's affordability. So some will request a minimum of £120,000 income. Some will want the amount of mortgage to be in your bank account. Some will allow downsizing as your repayment method. Some will allow downsizing as your repayment method if you've got a certain amount of equity combined with a certain amount of minimum income. So it really varies lender to lender. It's not going for an interest-only mortgage isn't as straightforward as a repayment mortgage.
Is it more difficult to get? Is it in terms of
their criteria is definitely a lot stricter than a standard repayment mortgage.
And that's because it's greater risk to the lender, because you can come to the end of the term and you've still got your debt
but
to pay.
that's why a lot of lenders will usually have a minimum income requirement or a minimum equity requirement. Some will have neither, but then what they do, they'll base it on a postcode, and they'll say to have an interest-only mortgage in this area, you have to have this amount of equity to be able to downsize.
Right, sure.
The other thing Steve did mention, which I'm a big fan of interest-only mortgages, is it's all very, people have repayment mortgages and don't understand interest-only. It's all very well, you pay 25 years, you pay your mortgage every month, you do your overpayments, you bring it down on a 20-year term, you get to the end of 20 years, you're now 55, great, I've repaid my mortgage. That's lovely, but it means all your wealth is stored in your house. There's only two ways to get the money out of your house. There's either sell and downsize, or you equity release it. Obviously, ideally, equity release, that will just compound up, and you obviously cost you a lot of money. If you downsize, you don't get to be in the house you want to be in. That's not wrong with doing either one of those, but the other situation is you can potentially invest the difference or do some other investment vehicle, and then try and beat you invest the difference, what your repayment and your interest on your payment would be, and over the 25-30 years, the hope that you'd build up enough investment to be able to pay off the mortgage and give you a lump sum at the end. So that means you've got your mortgage paid off and you've got a lump sum. You could travel the world, you could buy a new car, you could do whatever you want, but at least you've got some money outside your house.
It's not tied up in a house thing. And I suppose there is great advantages why advice is key. And again, to stress here, this isn't advice to anyone to get an interest only. You'd have to speak to an advisor to make sure your situation.
Can I just point in there? A mortgage advisor you have to speak to a financial advisor or a mortgage advisor with a financial arm within their company.
Yeah.
If you go to a straightforward typical mortgage advisor, they will not be qualified remotely to discuss this.
Yeah, and that's an important distinction to make. So in terms of, not all mortgage brokers are the same, because obviously Josh, you're a financial advisor, but you can do mortgages, and obviously the same for you, Steve. So, but obviously the one that you might go and see in estate agents will purely be mortgages, so can only advise you on the mortgage. And with interest only, there's a bigger thing to
yeah, I mean,
just that point there. Never ever be railroaded by an estate agent speaking to their mortgage advisor. That is potentially the worst possible decision you can make. A lot of the time they might not be acting in your best interest, and if estate agents say they're not going to put your offer through without seeing their mortgage advisor or getting a decision in principle, tell them they are breaking the rules and they cannot do that. Your offer has to be put through.
And the law.
So that's an important distinction. So someone's going to look at a house at the weekend. I know we're digressing slightly, but I've gone to look at a house at a weekend. I've already spoke to you guys, and they say I have to speak to their mortgage advisor to put through. They're not allowed to do that.
It's illegal.
It's
illegal. Now, going in our firm, there are three of us that do mortgages. There's Josh and myself, who are financial advisors, and Amy, who's a mortgage and protection advisor. But if Amy gets a situation where the client needs interest-only financial advice, she'll still do the mortgage, but send the person to either me or Josh for the financial aspect of it. So we still, as a group, can all do it. But Amy's got that backup.
Yeah.
If she's out there as a pure mortgage advisor, she wouldn't have that backup, and therefore people can't get the in-depth discussion about the interest only.
And that's the same important, because you can't discuss that the investment asset you talked about, and obviously said there's great potential advantages of having an interest only, because you've got now the money's in a separate repayment vehicle and not tied up in the house. You can do different things with it. What's the downsides though? What is the negatives? What's the risk, and why would it not be suitable for some people?
Discipline. Well,
And why did it fall out of favour? Why did
it fell out of favour because endowments.
Yeah.
Endowments were the problem. I mean, it never fell out of favour with me. I made lots of money by having interest-only mortgages, a lot of money.
Can you explain a little bit briefly why?
Well, I'll give you a simple number. I bought my house I'm living in 2001, I think it was, and I personally had a mortgage of £250,000 that I could have redeemed. And it was on interest only. I chose to leave that mortgage in place and use that money to do other things, which was invest, buy other properties. But
when you say you used that money, so you paid your interest only part, but also there was an element that you would have paid off.
Well, I had the 250. I had 250.
Yeah.
So consequently, I could have just paid my mortgage down. I had no mortgage. But I wanted to use that money for 15 years. I had a low interest rate. And so for the next 15 years, I used that 250,000 because my mortgage ran out in 15 years' time. Fast forward 15 years ahead, not only could I then pay the 250 back, but I had nearly £400,000 extra that I wouldn't have had if I paid that mortgage off in 2001. Because I generated that through property assets and through investment assets that I used for that 250. So to me, I never had a mortgage because I had the assets to pay the mortgage at any time. So for me, that's what I did. So if you're smart, and I consider myself smart, you can actually create wealth from that. But to make interest only work, you need discipline. You need not to see it as a way to have low mortgage payments for your life and just keep spending. That doesn't. It's really for the financially astute.
I think the other issue is what other people would have done throughout history is just to keep things simple. Their £100,000 house turned into £200,000. Their £50,000 mortgage, think, oh, I get more money at my house now. They keep refinancing up as the value goes up.
Yeah.
So after you keep going up and up and up. So you're never ever building up that equity in your house. I think that's a big mistake a lot of people make.
So people then release it to get more mortgage because they get the money out that way, but effectively it's tied up.
Living the high life.
So I know you were saying in terms of that you had a £250,000 to pay off the house, but most people don't have that. So how does it work in terms of the fact that I go and get an interest only mortgage, Dave, £250,000. I haven't got the £250,000 back, but how can that still be better for me?
Well, there's two ways. One that we covered the first part. You live in a better house than you otherwise would for the same payment, and let house price inflation create your wealth. Or number two, you live in the same house but make it lower payments, which frees up other money per month that you would otherwise have spent. That other money could be used to buy a second property, or it can be used to invest, and you can create more wealth that way. Because the amount of people in life that all they ever do is pay the mortgage down, and then they have to go to downsize equity release is considerable. So if you create the wealth elsewhere, you deal with the mortgage at the end, but it enables you to make money on money. Compound interest is the eighth wonder of the world, and that's what you're able to do if you use the money. The problem you've got is if people do interest only and they don't do any of those things and just live the high life, that's not really good. So you have to judge your client. Not all clients are suitable for interest-only mortgages.
And the reason being that, just to give you an example, if I was on a repayment mortgage, it might be £1,000 a month. But if I'm on interest only, it might only be £300 or £400 per month. So theoretically, I've got a potential £600 left over. And this is what you're saying, where people get in trouble in terms of the fact that you can use that £600 because I'm going to go and spend it and go out and stuff like that, when I could be using that £600 to invest, to then obviously, as that builds up over time, then better investment, I can potentially beat the rate of interest on the mortgage. Is that kind of...
So what I'm saying, so there's two options. If you're doing it to get a cheaper payment and you've got spare cash, you should treat that as a way to invest and create more money. If you're doing it as a way to buy a better house and accumulate house price inflation growth, then that's not what you do, because you're going to benefit from having a more expensive house and a better way to live. So there are two strategies depending on which way you're doing the interest only.
And it can be a bad strategy, because if you speak to them and you know it's not suitable and you think they're likely to go out, it's not always the best thing. So in terms of that, and what concerns would the lender have, and what concerns should people have about interest only?
What happens at the end of the mortgage term? That's the biggest issue lenders have, is how you're going to pay back the mortgage. That's why as I said, a lot of lenders require a minimum amount of equity and or a minimum amount of income, because they judge the higher earners can save the money to pay off the mortgage. That's what their standpoint is. And
then also as well, because there's only really one way then to pay off the debt of the mortgage, and that's to sell the property. And generally, if you're we talked about equity release. And if people don't know what equity release is, it's a form of mortgage, effectively, of a way of releasing the equity.
You don't pay interest on it.
You don't pay interest on
your
it.
people who inherit the estate have it deducted from the estate. Yeah.
But also, what the potential risk for that point of view is if you have an interest only and there's not enough equity in the house, equity release doesn't become a viable option. So then the only option you've got is to sell the property, and that's what we've seen some clients go because of the interest only beforehand. So basically, interest only is a viable thing. It's certainly been more thing, but getting advice.
It's excellent with the right advice, for the right client.
So if someone's coming up for mortgage term, come and have some advice. That would be the thing, to have a look at whether it was suitable, and it would definitely be something that you would recommend, depending on the client.
Well, we may recommend,
Sure.
totally dependent on the circumstances. Yeah.
So if you have got a mortgage coming up soon, or you're looking to buy another property, obviously get in contact. We can, obviously put the right advice. As we caveat before, we've mentioned it a couple of times, just to cover up again, this doesn't constitute as advice. We're not saying interest-only mortgages is the mortgage to get. You need to go and see a financial advisor to get the correct advice. Gentlemen, thank you very much. I think we've wrapped up with that, and we'll come to you soon. If you've got anything else you want us to talk about, obviously comment, email, so get in contact, and we can discuss the issues that you like.